Welcome back to Finance for Firefighters. Today we're going to cover more details in this MERP series. This one's going to be on MERP nuances, how the plan actually works, so you can see functionally kind of behind the scenes and have a better grasp of everything. So let's review some stuff on MERP. So MERP, or Medical Expense Reimbursement Plan. Think of it like a pension system, but just for healthcare. So you and your employer pay into it every month. That money is sent out of the city's coffers into MERP, and it's professionally managed there. They manage that through real estate, stocks, bonds, all sorts of other stuff in the market, and they plan for like a 30-year horizon so that they have the ability to pay folks back with it. The more money that's put in there on your behalf and under your own name and your account, the more your benefit is. The money's professionally managed. Again, it's out of the city's reach, and it's invested over a period of time. When you retire, you have access to that money, and it comes in the form of a lifetime medical benefit, so like a lifetime medical pension system for you. So your medical premiums, any other costs that you incur as a result of medical expenses that IRS deems as qualified medical expenses, you can use that money to pay for those things. Okay, so we talked about ASUs in the episode before. ASU, or Active Service Unit, is basically the amount of time that you're earning through MERP, okay, if we draw the parallel to the pension system. Every ASU costs $25. So once $25 between you and your employer has gone in there, that ends up being one ASU, or one amount of time that you've earned for MERP, right? So those are earned normally through your paychecks, their contributions through employee and employer, and all that money continues to stack up, and those ASUs continue to stack up over your career. So the ASUs are not based on rank, they're not based on any other kind of like your hourly pay or anything like that. It's the same price for everybody during the normal contributions. One ASU costs $25, doesn't matter if you're a firefighter or the fire chief itself. Same cost across the board for those things. And the amount of ASUs that you earn up over the amount of money putting in there will be the amount of money that you'll be qualified to get based on how the actuary is set up. Okay, so the ASUs work functionally the same way. That's your normal contributions that you and the employer are doing throughout the course of your career. You also have something called leave conversions. So that would be anything from, for our local, it's vacation, sick leave, and then management leave are pinned into those things. You can do that either annually, 120 hours a year annually, or at retirement, you can, or both, you can do it at retirement as well. You could cash out your sick leave or vacation or management leave for MERP ASUs also. The downside about purchasing in a lump sum thing that's different through that schedule that's sort of set up through your MOU is that when you purchase them, the leave conversions either annually or at the end of your career, they are actuarially adjusted. Big fancy term, what does that mean? Well, that basically means that MERP has less time to invest that money, so they're going to charge you more for putting it in there. You're not getting as much bang for your buck, right? So for a 20-year-old person, it's going to be cheaper, right? They have 30 years for them to invest that money over your career, right? So an ASU for a 20-year-old person is going to be much less than an ASU for a 48 or 49 or 50-year-old person, right? If they have less time for that money to be put into that account and invested, then it's going to have less time for it to grow. It's all part of like them balancing their books on being able to pay the pensions to the other folks. So it's still a great deal. It's still a great way to do it. If you have a couple thousand hours worth of time, that's going to be tens of thousands of dollars you're going to pay all that tax money on in retirement if you get a big check from it, or even if you transferred it over to your deferred comp. There are limits on how much you can do in your deferred comp, and you're still going to be taxing that money as it's coming out through deferred comp. If you have, let's say, $50,000 worth of sick leave, vacation leave, management leave that you transfer into MERP for ASU credit, you're never taxed when that money is paid over there, and you're never taxed when the money is taken out of it. So based on most of us, our taxable income is anywhere from that 25 to 35% range, especially in retirement when you have pension, things like that. That does make a huge difference. So if you have a bill you have to pay for anyway, like your medical premiums, using this for that and not having to pay taxes on it is a great way to do it. So if you have a lot of money you are going to be taxed on, either through a large check at the end of your retirement that they would just pay out to you. If you transfer it over to MERP, you pay no taxes on it, and you build up even more ASUs. Important note to make for us specifically is that you cannot use comp time to cash out for ASUs through MERP. And this is all part of IRS rule stuff. Because we have the ability to make comp time, if we work an overtime shift and we get paid overtime for it, we could either take it as time, or we could take it as time off and comp time, or we could take it as pay. Because you have the ability to do both of those things, the IRS won't allow you to put comp time into MERP. The only really workaround for that would be is if a department or local, we said, hey, we don't ever want to get paid overtime money again, we want to just be able to have comp time, then it would qualify for it. But you'd have to do a whole restructuring of it. And I don't think there's going to be a whole lot of people who want to work overtime and then never get paid extra for working overtime and only be able to take comp time. So that's one of the reasons comp time doesn't work for it. So let's talk about MERP eligibility. Okay, we talked about this a little bit in the previous episode, but the minimum requirement for eligibility for MERP is that you need to have 5 years worth of contributions or 5 years worth of those ASUs to go in there. If you don't have less than 5 years, or if you have less than 5 years, then you won't qualify for the lifetime benefit. If you have 5 years or above, you get the lifetime benefit when you retire, and you're able to capture that in retirement. If you have less than that amount of time, and again, we'll get into some more details about how you can kind of work around that through different mechanisms. If you have less than that 5 years, that money is still your money that's been transferred over there, except that instead of being part of that trust, they just pull it out of the trust and they put it into what's called an individual account. That individual account would be more like a 457 on your behalf. So if you put $100,000 between you and the employer into MERP on your contributions during employment, but you have less than 5 years, they're going to take that money out of the trust and they're going to put it into an individual account in your name. Functionally works the same way. You're never paying taxes on it. You can use it for the same kind of expenses, except that now it's a defined contribution. It's not a defined benefit like the pension side of it. So that money is still usable the same way that MERP is used in the lifetime benefit, except you're not getting a monthly check. You basically have access to it. So if I need to pull that money out, I can pull it out and use it to spend on those expenses. Downside is once that money's gone, then it's gone, just like a 457. Once it's empty, it's gone, versus the pension side where that money you'll continuously get a check from basically until you die at the end of it for it. So a little difference there and the eligibility qualifications for it. So if we look at normal contributions that you do through your paycheck or your leave conversions, let's just kind of break this down a little bit and get into the specifics on it. So normal contributions that you do, there's a table or a scale set up from years of service or age based, depending on how your locals set it up. For us, we have it based on years of service. You have certain contributions amount based on years of service. It has nothing to do with rank or pay scale or anything like that. Those certain contributions go in there, and then depending on how much time you put in and the amount of money, that'll be your qualifications for your ASUs or your benefit that you get in the end. The difference between that and leave conversions are basically, I'm deciding how much I want to put in either annually or at retirement. And because it's not done through the normal processes, that money is now going to have the actuarially adjusted higher amount or lower amount depending on when I do it. If I'm younger, it's typically cheaper. If I'm older, kind of the age of 40 ends up being the breaking point. Above the age of 40 and above typically is a little more expensive to buy the ASUs, and less than 40 is cheaper because they have longer to invest that money. But basically, those are your two different mechanisms. So if you have your normal contributions, that's kind of setting up like, hey, this is what I can look out at and extrapolate at. If I've got 10 or 15 or 20 years, how much money will I put in? You can kind of run that. How many ASUs do I have? Okay, here's what I'm looking at for at least my baseline benefit. And then if I'm close to retirement and my wife and I are going to be either relocating or staying exactly where we are, I sort of shop around and find out exactly how expensive it's going to be for my benefit. And I can add in those leave balances or my leave conversions, cash that leave out at the end to be able to bump that benefit up from what the baseline is. Another point to mention, again, I'm sort of hitting a lot of different angles on this, but MERP is very portable. So you have it through your employer. That money you put in, the money that they put in that goes to MERP is basically under your name. It's your account through them. So if you have the lifetime benefit, you're going to get the lifetime benefit when you retire, or if you do the individual account or a combination of both, you're going to have access to that when you retire. But the main point is it's portable for you. That money is your money once it goes over there. So if you retire, if you change departments, if you get fired, whatever, all that money is now in your account under your name. So it's not tied to the city or your employer. Let's go through some common questions. In retirement, can my benefit go down? Pretty much once you have your ASUs locked, the likelihood of that benefit going down is very, very low. If anything, depending on how well the fund itself is doing, there are increases to it, like you could think of them as COLAs as time goes on. But generally speaking, once you have your lifetime benefit in there, it's not going to really go down. What are the tax implications of MERP? Well, you don't pay taxes on the money going in. You actually lowers your monthly income by contributions you make. The money grows in there tax-free because it's through set up through the trust. And then as you get paid that, you're never paying taxes on it. So money that you normally would spend, let's say you had to pull money out of your 457 to pay for a healthcare premium, you'd pay taxes on that to pay that healthcare premium. But for MERP, because it's a qualified medical expense through this, and that's what it's set up for, if you have the same expenses you pay for it through MERP, you don't have to use your 457 in your pension to pay that. You're not paying taxable income to pay for something that can be tax-free. So huge benefit of this is there's really no taxing on any of this stuff for you. If I change agencies, what happens to my MERP? Well, the MERP account is under your name. It's your money. It's portable. So if you change agencies and that agency has MERP, then you can continue making contributions based on what their MOU and all the other stuff related to them says. But that MERP money is yours. Should I convert leave annually? Well, this is case specific, but the thing I would do for this is I would look at the specific table for you and say, hey, what am I going to look at when I'm getting my benefit? When am I planning a retirement? What is my spouse do? Do I have lifetime medical through her? What are the other implications for that? Sort of plan ahead for what you need. And if you need to bump some of that money up, then paying into MERP to do some leave conversion stuff earlier may have some benefits to you. If you're one of those guys that's been super involved in real estate, you've got a bunch of rentals, or you've got a ton of money invested on the side or something like that, and you've been really really good about saving, and you're going to be able to retire at an earlier side. If you're 35, maybe you want to dump some of that money into MERP and build up some more of those ASUs. So when you hit 50, or maybe you're one of those guys who plan so well ahead that you're able to retire at the age of 45, if you hit those things earlier, you can build up those benefits and then have that MERP benefit whenever you separate. So understanding MERP will make you that much more capable of using this super powerful, very, very helpful tool at your disposal. So follow the rest of the series on this. I'll get into more nuances of the actual splitting up the money and some other things related to it. Thanks for joining me on Finance for Firefighters. Hope you guys have a good shift. Thumbs up if you like it, comments below. I'll see you guys in the next one.